Everyone just wanted to do equities. Everyone just wanted to invest in every IPO, every small cap, every mid cap.
What would you say are red flags to not be invested in today's?
No sector is ever a permanent red flag, and no sector is ever a permanent green flag.
Are there any sectors which have positively surprised you or negatively disappointed you?
So auto has been a good positive surprise. Out of 14.6 lakh crore that I mentioned, 1 lakh crore will now come from auto.
So when it comes to these high growth companies, because there are a lot of new age IPOs which are coming, they are all pricing their IPOs thinking about high growth, right? And that's how they are justifying the valuation. Do you see any sense in some of those IPOs?
So in new age companies, you have to be mindful of two more things, which is, are they profitable? Quite a few of them are not. Then you need to know their path to profitability. Now I am okay buying a loss making company also, as long as we have a visibility of profitability.
If you were designing, say, a 100 crore portfolio in today's time, 2026, how would you allocate?
So I'm a growth focused person. I've always been a growth investor. Second, I don't like heavily leveraged companies. Third, I prefer structural stories.
What are some realistic return expectations to have in this kind of a market?
So you should expect returns which are commensurate with your underlying earnings growth. So CAGR of 12 to 13% basically, that's what the return expectation you should have from the market.
So what does it look like if you had to take some bold predictions? What would it look like for 2026?
I would definitely feel that 2026 will turn out to be a far better year than 2025, primarily owing to three things.
Hello and welcome everyone to the India Opportunity Show. I'm your host Shrishti. And today I'm joined by Mr. Gautam Duggad on the show. He's the Director of Equity Research at Motilal Oswal. In today's episode that we recorded right after the budget and the India-US trade deal announcement, we'll be talking about how Gautam thinks about the overall sentiment in the market. We also discuss which sectors he's personally bullish on and how he would design a 100 crore portfolio in today's time in 2026. While he missed out on the precious metals rally, he talks about some of the sectors that are his darling favorites and what are the signals to watch out for in certain companies. Gautam is truly fantastic and most insightful when it comes to understanding market cycles, sentiment, and overall macro facing the market. Hope you enjoy watching. India is one of the fastest, largest growing economies around the world. And if you want to participate in India's growth story, you need to be backing Indian businesses and companies. Whether you're someone who's already been in the markets or has just started investing, Grow is the place to be. Grow gives you a clean, simple, and intuitive investing experience, which is unlike any other investing platform. You can invest in stocks, mutual funds, ETFs, IPOs, and even commodities, all in one place. You can track your portfolio performance, sector-wise distribution, and get a comprehensive view of all your investments, all with just a few clicks. No wonder Grow has now become India's largest stockbroker, with over 1 crore active investors. Check out Grow. Hi Gautam, welcome to the India Opportunity Show. Thank you for joining me here today.
Pleasure.
You know, we've had such a wonderful weekend, to say the very least. We went from the market sentiment being hit on budget day, and then the India-US trade deal happened. So the market has completely shifted its sentiment over the last 2 days. It's all happened in the last 48 hours. I would love to start there. And what's your take on it overall?
Yeah, I mean, things change and how, on Sunday, there was not a single person who was willing to raise his hand and say markets will open higher or close higher next day. And then on Monday, we saw how the markets rallied 1,000 points and then subsequently followed through with yesterday's rally of 2,000 points. Look, budget always receives disproportionate attention for a couple of days. We've been of the view for last few years that budget becomes irrelevant in 2-3 days, unless there are some big seminal changes which get announced, which also nowadays happen outside of the budget.
Yeah.
Just imagine if instead of cutting the GST rate in September, they had announced that in the budget 6 months later. We would have all called it a dream budget or some such nomenclature. Right? So big actions nowadays are happening outside of budget, reforms, policy initiatives. So budget nowadays has become more like a event which is business as usual. It basically reinforces policy continuity. That's what we saw. the sentiments got soured because of the STT increase. Otherwise, I think budget was fine, an exercise in continuity with focus on fiscal consolidation, central government capex, and some of the new initiatives that they've announced on data centers and strategic investments around electronic manufacturing component. So I think it was a perfect, fine balancing exercise. But yeah, I mean, the news flow turned adverse because of the step on increase on STT that they've done. Now, uh, it all got overshadowed by what happened day before yesterday with the announcement of the US trade deal. It's a big deal. Everyone has been waiting for it for more than a year now. It changes the contours for India materially on multiple fronts: strategic, political, geopolitical, and of course, economy and markets. From being the most tariff nation at 50%, we are now the fourth least tariff nation at 18%. I think there are 3 or 4 countries which are below us: EU, UK, I think Japan, and maybe Switzerland. So clearly, it reestablishes India's preeminence in the global supply chain, global strategic developments which have been happening for the last 2 years. So we made a big comeback in a matter of 6 days, closing 2 big deals with European Union and now with US. Augurs very, very well. It lifts the sentiments because this has been a big roadblock for last 12 months.
Yeah.
Whomsoever we've interacted with in the FI circles, they've been, kind of highlighting that India has been singled out on the trade treatment by US, and that was not going down well. It also had implications for our currency. We were amongst the worst performing currency in calendar year 25, which obviously plays spoil sport with the equity returns that the FIs make, right? And it coincided with slowdown in corporate earnings. We'll come to that in the conversation later. So a lot of things came together: expensive valuations, slowdown in corporate earnings, and this US trade deal getting jammed. So the announcement of it, and now of course we'll wait for the final details. A joint statement has not come yet. I think the Commerce Minister yesterday mentioned that they will be releasing the joint statement in a couple of days, and then of course the final prints will come out. So we'll have to see the details. But for now, it is a big sentiment booster for both market economy. It helps the export. It helps jobs because we've been hearing stories from a lot of SME companies in the textile, leather, gems and jewelry, how orders were getting blocked and how it was going to have an impact on the investments and job generation. So to that extent, it's a very big relief for economy. From a market perspective, I don't think it has any meaningful impact on numbers, but it has a huge impact on the multiples. India right now is trading at its lowest relative premium versus emerging markets insofar as valuation multiples are concerned. So large cap indices are in a long period average. Mid cap and small caps are still trading at an expensive valuation. Now this deal obviously, I hope, if not leading to inflows, at least it will stop the outflows that we've been seeing on the FPI side for last, I think, 24 months.
Yeah.
Because calendar 24 also there was a net outflow of $1 billion. 25 it became $19 billion, and calendar 26 we started with an outflow of $3.5 billion in first month itself. So our hope and whatever discussions we've had is India is now back on the discussion table. Now obviously we cannot expect a linear rise and sudden change in approach. Gradually and slowly it will evolve. The important thing is it needs to be followed up with a good corporate earnings growth, which has been lacking for last 2 years. We are seeing good earnings momentum this quarter, and our hope is that this will continue in FY27. The outlook for earnings is looking slightly better now after 2 years.
But like you said, the valuations for small and mid caps are still on the expensive side.
Yes.
However, like last 2 days, whenever I've seen interviews on CNBC and other news channels, all the market veterans are coming and saying that, this is the start of potentially a new bull run for India, and, the rally will possibly continue in certain sectors, right? So are you seeing that too, or do you mirror the same sentiment?
So I think bull run never stopped post-COVID. There's been a marginal correction that we have seen. I mean, look at it from a point of view of indices. Nifty is down hardly 5-6% from the top. Yes, there has been a time correction because we are still below the September 2024 levels. Midcap index is down, I think, 6 or 7% from its recent highs. Small cap index somewhere close to 10 to 12%. Now, this is a very plain vanilla bull market correction in my view. So it's not as if that bull market had stopped. It was taking a breather and it was waiting for corporate earnings to catch up. Now, the point on valuations is mid caps have always been expensive. It was the small cap which used to trade at a big discount to Nifty. If you look at a long period average of small cap index, it is somewhere about 16, 17 times. Nifty is 20 and a half times. So usually small cap trades at a 15% discount to large cap. Now the small cap valuations, despite the time correction and price correction of last 1.5 years, is still at 23 times. So at a 10% premium to Nifty. Now this period has also coincided with a very lackluster earnings growth in small cap. So last 5 quarters, small caps have barely posted any growth. It's between -2 to +2%. This is a quarter where we are expecting a turnaround in earnings for small caps. And as of yesterday, more than, I think, or roughly 100 small cap companies in our coverage universe have posted numbers. There, the earnings growth is somewhere close to 23%. Marginally below what we expected. I'll still call it in line because we were expecting about 27% for these companies. So small cap earnings are picking up. And if it sustains for next 2 years, I think then there are a lot of bottom-up opportunities which are available even in an otherwise richly valued index. Now, mid-cap, the story is very different. Now, look at mid-caps. Mid-caps for last 2 years have been growing at a pace of 2x versus large cap. In FY25, when large caps grew at 4% earnings, our coverage universe of mid-cap stocks, and we cover 100 mid-cap stocks, they posted a 10% growth. This year, we are expecting large caps to do about 10 to 12% earnings growth and mid-cap to do about 20%. So clearly, mid-caps deserve to trade at a premium given the earnings growth differential which exists. In between, there will be a quarter or two where mid-cap earnings may be slightly disappointing. But on a trend basis for last 2 to 3 years, mid-caps have done really well. The entire corporate earnings profit pool has done well. If you look at our own coverage universe of 355 stocks, in FY20, the total profit pool for this 355 stocks was, I think, 4,91,000 crores. This year, we'll do about 14.6 lakh crores. So almost 3x jump, which is and I was looking at a rolling 5-year earnings CAGR from FY19 onwards. It's consistently 19, 20, 21% band. It's just the last year, FY25, where earnings were flat. And this year, the broader market earnings are going to be far better than Nifty. We'll discuss the nuances of that as we move forward. But just to put the point on the table, we are expecting about 14% growth this year, FY26 for our coverage universe, and just about 7 or 8% in Nifty. There is a reason why the differential is so high. And then subsequent next 2 years, we are expecting the earnings to move in a 14 to 15% band for our coverage and 12% CAGR for Nifty. So from 5 lakh crore roughly, we are already at 14.6 lakh crores in terms of profit pool. And in the next 2 years, we are expecting this profit pool to touch closer to 20 lakh crores for our coverage universe. Same number for Nifty if you were to look at. I'm just giving you the absolute number so that you understand the whole scale of profit pool upliftment that has happened post-COVID. So 3.8 lakh crore was the profit of Nifty 50 companies in 2020. Now we are going to do somewhere close to 8.7 lakh crore this year, FY26. And next year, our projection is 10 lakh crores. And then another 14% growth, so which will take it to 11.5 lakh crore. So the size scale of the Indian corporate profit pool has gone up tremendously. It's just that on that high base, now the growth is normalizing to 12-14%. And within that, you have several segments which are like large cap growing at 10 to 12% because of their size. And some of the large cap sectors like consumer, financials and IT are now normalizing on a high base. Whereas mid caps, you still have 18-20% growth, which is available. And within that 20% index growth, you will always be able to find 10 to 15 companies which can grow at 25%. Which is where the incremental delta in a portfolio will come from.
So that's very interesting. Thank you for quantifying with numbers, because there's this overall sentiment that the earnings have slowed down and they are not growing, and this bullishness around mid caps and small caps in a way then can be justified as well, right? Like considering, like, if you were to design your portfolio today in 2026, if large caps are not expected to grow as fast, like, so should you be more towards small and mid cap in
No,
your
I think one should adopt a blended approach because large cap provides stability and mid cap provides that incremental extra delta, right? It is a function of your risk appetite. You know, how do you construct a portfolio will be very different from how I will construct my portfolio, depending upon your individual risk appetite and what goals you are, looking for. I think mid caps, obviously, on a 3, 5, 10-year basis, if you look at the corporate earnings, they have given a 200 to 300 basis point of extra outperformance over large cap earnings. So, in my own coverage, if I look at 100 large cap companies that we cover, the large cap earnings on a 10-year basis have compounded at about 10 to 12%, whereas mid caps have compounded at 16%. The intriguing thing is the small caps have compounded at hardly 8%. So they've been really through tough times.
Yeah.
You had big impact of demonetization, GST, and then post-COVID, the pricing power got eroded, and there were a lot of upheavals in supply chains. So all of that period is contributing to the moderate 10-year earnings CAGR of small caps that we are seeing in our coverage universe. But net, I would still believe that mid caps will continue to outperform on a slightly longer term frame. In between, there will be a quarter or two where mid caps will suddenly show a very different, I would say, tendency on the growth. But that's par for the course given the inherent nature of the business in mid caps. But on a trend basis, mid caps generally provide you 2-3% incremental earnings delta over large caps. But do remember, Shrishti, large cap constitute 80% or 82% of the total profit pool. When I look at my own coverage universe, the number I just told you about, 14.6 lakh crore is the total profit pool for Motilal Oswal coverage companies. 82% comes from large cap. About 12 to 13% comes from mid cap. And only 4 or 5% is coming from small cap. So if you're an individual investor, retail investor, obviously you can construct a portfolio of only mid caps or small caps also. But if you're an institutional investor, which is what we cater to, you can't do away with large caps.
You have a lot of institutional investors who are clients, right? So
no, I represent institutional equity segment only. So all my clients are institutional clients.
Yes. So then when you talk to a lot of these clients, what is the sentiment looking like? Are FIIs looking at India again? Is the sentiment changing?
Yeah, I mean, I'll give you a simple anecdote. I was doing my marketing in one of the geographies last week in Asia. I met about 20 funds in 3-4 days. The sentiment was very, very subdued around India, especially the people who manage regional funds who option not to invest in India. So they've made a lot of money in emerging markets, in developed markets. And those markets are still trading at a cheaper valuation versus India. Plus, it coincided with better earnings growth in those countries versus India. As I said, last 2 years, the Nifty earnings have hardly grown at 4-5%. So for them, the question was very simple. They were losing money on currency. Valuations were expensive. Corporate earnings were not coming through. And the competing markets were turning out better on every front. So they really had to justify why to commit more money to India at this stage. So they were happy being underweight. Now things can change. And I can see already a lot of conversations happening in many of these funds, which had stopped for last 6-12 months. So they are reassessing India now in the changed context after the US trade deal. And as I keep saying, people will forget the trade deal after 2 months, 3 months, or maybe 6 months. What will remain is the importance of corporate earnings. Eventually, markets give you returns which is broadly convergent with corporate earnings growth. Like I said, FY 20 to 25, you've seen 20% or 19% earnings CAGR, whether in my universe or in Nifty. In that period, market gave you more than 20% return. Last 2 years, earnings have flatlined, so market is also flatlined. Now, obviously, we can attribute it to different narratives on global macro, trade headwinds, geopolitical problems, XYZ. But the point is, corporate earnings didn't come through.
Yeah.
When earnings were coming through, despite all the problems globally, markets kept doing well.
So what does it look like if you had to take some bold predictions? What would it look like for 2026?
No, I would definitely feel that 2026 will turn out to be a far better year than 2025, primarily owing to three things. One, earnings outlook turning brighter. That we think will happen. Second, lot of steps that the government and RBI have taken in the last 9 months, and government and RBI have done a huge amount of heavy lifting on both monetary and fiscal side. You had income tax rates which were cut last year in budget, then GST cuts happened. RBI has played its part by cutting interest rates by 125 basis point. We are hoping for one more cut on Friday. Let's see. So the positive effects of all these steps that has already been taken, I think will manifest as we move forward. And that will definitely add to the earnings. Third or second, I think even the nominal GDP growth will pick up. Last year we did just 8%. Nominal GDP of 8% is a very, it has very different implications on your tax collections, corporate revenues, corporate earnings, wage growth in the economy. I mean, nominal number is what people feel. Real GDP is not what someone feels, right? So with inflation making a small comeback this year, and government has already budgeted 10% nominal GDP growth next year, I think they will do better than 10% with the deal getting announced, export outlook looking better, and the monetary easing transmitting through the economy. So I think nominal GDP can overshoot by maybe 50 to 100 basis point, which might look small but has a multiplier effect. It can have a multiplier effect on credit growth also. If your credit is growing at 12% in the economy today, if it suddenly starts growing at 14, 15%, you get a very different corporate earnings number, right? So that is the second thing. And third, the froth which was there prevailing in the broader markets in 2023, 2024, large part of that has gone away. You've had massive euphoria in 2024. Everyone just wanted to do equities. Everyone just wanted to invest in every IPO, every small cap, every mid cap. After 15 months of sober markets, and of course, a lot of mid cap and small caps have corrected more than 20%. In fact, if you look at NSE 500, which is the largest and broadest index, which is basically accounting for 90% of India's market cap, in that index, out of 500 stocks, 57% stocks have corrected more than 30% from the top. And if you add a 15% bucket also, it's almost 83% of the stocks. So more than 400 stocks out of the 500 in NSE 500 bucket, they've fallen anywhere between 15% and above, within which 300 stocks have fallen more than 30%. So while the index is not showing you much pain, if you talk to the portfolio managers and investors, their portfolios have bled. Right? So the euphoria has gone away. There's no madness in the market right now. Sentiments are very sober, and that generally prepares the foundation for the next leg of an up, which is why we are quite constructive on the market, and we feel that FY27 or CY26, as the case may be, can be far better than what we have seen in the last 2 years.
That's so true, because people's portfolio have really bled, especially people who went very overweight, small and mid caps. What are some realistic return expectations to have in this kind of a market scenario?
Look, like I have been saying in my external media interaction, I think at 21 times or 20 times on Nifty, and we are using Nifty as a benchmark right now, the room for re-rating is very limited. So you should expect returns which are commensurate with your underlying earnings growth. So if our predictions of 12% earnings CAGR for next 2 years on Nifty, 15% this year, 12% in the subsequent year, so CAGR of 12 to 13% basically, that's what the return expectation you should have from the market. Now, within that, if you do the hard work, you do bottom of stock picking, you do your research well, you can hope to earn more, right? Because look at Nifty itself. Calendar year 2025, what was the return of Nifty?
Not barely any digits, I
11%.
think. 11%?
Yes.
Oh.
Right. Now tell me, what was the return of the best performing stock in Nifty?
25?
72%.
70.
Shriram Finance. And now tell me, what was the return of the worst performing stock in the Nifty?
I'll get this one also wrong, so you may as well tell me.
It's Trent, which fell 40%.
40%, yeah.
So in an index which gave you 11% return, the dispersion of returns between the best performing stock and the worst performing stock was 112%. So 72% from the best performing stock and minus 40 from the worst performing stock for that year. So market will always, from a longer term perspective, 3, 5, 10, 15, 20 years, will be in that 12, 13% CAGR bucket. But within that, below the surface, a lot of action happens, right? So you can say, Nifty gave you 11% return, but if you're lucky enough to identify 3, 4 stocks which did well last year, likes of Shriram Finance or the likes of auto names which did really well, some metal names like Hindalco and all which doubled from the lows when that news of the fire in one of their plants in US came, you would have made very different returns.
Yeah.
On the other side, if you're stuck in the wrong names, so bottom-up stock picking is always important. We have this, a lot of experts, and we also stand guilty of that. We keep saying this is a bottom-up market, this is stock pickers market. Every market is a stock pickers market, right? So index level shouldn't expect more than 12-13% CAGR on a 2 to 3 year basis. In between, you might see suddenly in 3 month market shooting up and then correcting. That can happen. It can happen any given day. Markets correct 4-5% without any reason. But on a sustainable basis, from a 3 year perspective, I think earnings is what will decide the trajectory now. For whatever reason, if we get 15-16% earnings compounding instead of 12, then you are in for even better times. But even at that 12%, you can still find ideas which can give you more than index returns. That's the beauty of the stock market, and that's the beauty of India, because the diversity in investment or options for investable stocks are massive here. We used to cover 200 stocks 5 years back, and that was 74% of India's market cap. Today we cover 350 stocks, 356 stocks actually, and they're still 75% of India's market cap. So the market has moved forward. A lot of new sectors have emerged. A lot of new listings have happened. The primary market has been extremely vibrant for the last 2 years, and I think it will remain vibrant in the foreseeable future. So for an asset allocator, the job has become interesting but complex, right? Because he has to now decide between multiple options in every segment, every sector, be it consumption, be it financial, be it technology, healthcare, industrials. Whichever bucket you choose, the option of investable ideas has gone up massively.
Yeah. So, because a lot of the audience of the show are actually founders, investors, family offices, a lot of people who built businesses also invested in businesses. If you were designing, say, 100 crore portfolio in today's time, 2026, how would you allocate?
So I'm a growth focused person. I've always been a growth investor. So that is the overarching feature of my stock selection criteria. Second, I don't like heavily leveraged companies. Third, I prefer structural stories. Now, whatever I am saying is very commonsensical. If you ask this question to 100 people, maybe 80, 90 will say the same thing. Also, I've been a consumer analyst before I became a strategist 10 years back. So I've always had more affinity for companies with stable, predictable cash flows, higher free cash flows, and predictability in earnings growth. So my portfolio will be, if you see even my model portfolio today, it's dominated by this kind of company. We are overweight on financials. We are overweight on technology. We are heavily overweight on consumer discretionary and auto. We are underweight on commodities. Most of my career as a strategist for last 10 years, barring 6 months post-COVID or maybe 12 months, we've been underweight metals, we've been underweight oil and gas, we've been underweight commodities. And as of now, we are also underweight consumer staples and private banks, right? Growth stories with good balance sheet, cash flows, and very good management pedigree. The only thing where I differ is I am not afraid of buying a high PE stock, right? Because we've seen in India, there are hundreds of cases where on a 15, 20 year, 10 year basis, the compounding has been massive. Even if you made some mistake on valuation, not on business. But if you had made a mistake on business and management, and you still ended up buying a reasonably priced or extremely cheap company, your compounding may not have been good. So in India, growth matters a lot because it's a growth economy.
So you're okay backing companies with PEs of 100, 200?
So we have actually, one of the longest times we've had a buy call on Titan. It's been our favorite top idea for last 15 years now. It's never been cheap. Trend, never been cheap. At 100 rupees when I joined Motilal Oswal, the price was 100 rupees on that day. I remember it, 21st of August 2012. Market cap was 2000 crores. Stock was trading at some 80-90 PE. From there, from 100 rupees, it went to 8,000 rupees in March 25. So 13 years, stock became an 80 bagger. It was again 120 PE because growth was coming through. But the flip side of that is when the growth came off from 40% to 20% or 17% in the next 3 quarters, the stock has come up by 50%. So you have to get your growth calculations correct, visibility on growth correct. You may not get it right 100 out of 100 times, but if you're able to get it right more often than you're getting it wrong, as a portfolio manager, you will still perform well.
So when it comes to these high growth companies, because there are a lot of new age IPOs which are coming, they are all pricing their IPOs thinking about high growth, right? And that's how they are justifying the valuations. Do you see any sense in some of those IPOs?
So in new age companies, you have to be mindful of two more things, which is, are they profitable? Quite a few of them are not. Then you need to know their path to profitability. Now, I'm okay buying a loss-making company also as long as we have a visibility of the profitability. Zomato didn't make profits when it listed, but it's been a phenomenal wealth creator.
Yeah.
It's part of our model portfolio of the top ideas that we have. But not every new age company will make money. Some will disappoint, some will not scale up, some will not make the returns which are commensurate with the capital efficiency that you desire as an investor. So you have to be more choosy there. You have to be more mindful of what you're paying for. And again, I mean, you can get growth in top line, but you may not get, that may not translate into bottom line growth. Eventually, market needs profit, if not today, maybe 2-3 years later. It's good, you can trade and, for a couple of quarters, people get enamored by 30-40% top line growth and companies are still making losses. But after a point of time, investors demand profits because ultimately, what is equity? How do you value equity in its truest sense, the intrinsic value? You discount the cash flows or you discount the dividends, whichever model you use. How do you discount the cash flows if you're not making a cash flow? So how do you value? So beyond a point, if you do not have a visibility on profitability, it's obviously going to be a very skewed risk reward.
What are the signals to look for to know when to sell if you found yourself in one of these opportunities?
This is the most difficult decision you have to make as an investor always. And
because you can't know the top,
every
right?
veteran you would have heard, you would have done podcasts with so many big veterans in the market. They all would have told you that, the hundreds of books have been written on what to buy, how to buy, when to buy. Very few books are available on what to sell, when to sell.
Yeah.
So two things I follow personally. Sometimes it has worked, sometimes it has not worked. From a longer term perspective, if you're looking at things, when to sell is when you see growth coming off the cliff, markets getting saturated. So that helped me make a call on consumer staple 5 years back. So we've been underweight on consumer staples since 5 years now in our model portfolios, and we have zero allocation to consumer staples since last 9 months. The reason is simple. We thought that growth will continue at 14-15%, which is what we had gotten used to from 2010 to 2015. Then 2015 onwards till 2025, if you look at the financials of consumer staple companies in India, there's not a single consumer staple company which is compounded top line at 10%. The reason is a lot of categories had reached the saturation level in terms of penetration, in terms of, I won't say per capita consumption because we are still a $2,800 per capita economy, but the low-hanging fruits had been plucked. I'll give you a simple example. The oral care category, when I had started tracking as a consumer analyst in 2007, had a penetration of 72%. And the largest company in oral care in India, with more than 50% market share, they grew their volumes in double digit for 4 years in a row. Then in 2014, the penetration levels of oral care reached 95%. Now look at the last 10-year top line compounding of the same company. It's hardly 4 or 5%. So when your category growth matures, when your penetration levels reach a certain point, then obviously as a company, if you're not created additional growth drivers, the same set of products or portfolio are not going to carry you through. So then as an investor, you need to make up your mind. Are you okay paying 60p, 50p, 70p for a 8%, 10% growth? Yeah. In some cases, you might have a view that the growth can recover from 10 to 15 because of ABC initiatives that the company has taken. Or you may decide that from here the growth is not going to recover, and I've made my money, or I have not made my money, so I'll correct my mistake. Yeah. If I have made my money, I'll exit. So growth outlook, the TAM, the size of the prize as we call it, and whether the companies are staying ahead of the curve. So I found that consumer staple companies' growth has come off significantly, and it's going to take time to recover. They've not yet recovered. A lot of benchmark bellwether names in consumer staple sector have not given any return for last 4 to 5 years. Yeah. Right. Now the second is obviously valuations. I am not afraid of paying high P, but then that has to be backed by growth. So if there is a big mismatch, right? Say you bought a high growth company in a high growth sector. Let's assume a company X, it is growing at 40, 50%. You ended up paying 100p or whatever, 120p. Good ROE. Now, for XYZ reasons, the growth comes off from 40% to 20%. 20% growth is still fine. It's not a bad growth. But you paid 100p, right? So if 40 is going to 20, obviously there will be earnings downgrade. At the same price, the PE looks more inflated because the earnings have been, revised downwards. Now, again, there a judgment has to be taken. A lot of times it is very subjective, and you can go wrong, obviously. You have to take a call whether this growth can recover. If not, you have to cut your losses. And because, see, India is a massive market. There is a huge opportunity cost of capital, right? Sometimes you can take a very strong ideological, headstrong view that come what may, I'm not going to exit from this company, which I have taken in few companies. Or you can be more flexible and say, okay, I've made a wrong judgment. There is a opportunity cost to my capital, and there are enough opportunities available in the same sector or other sector. So I might as well reshuffle.
Right? So now let me ask you about the companies which you decided that you will stay invested in and you've held for very long term. What are some of those companies, if you can share?
One is obviously Titan. That's been our favorite house idea for more than 15 years now. The reason why we've stayed invested and still a part, in fact, still a number one top idea for us in discretionary.
You would still recommend it?
Yeah. We have it in our model portfolio. It's part of our top 5 India ideas. It's the size of the prize, $80 billion jewelry industry, Tata Group company, massive trust, massive brand equity, and a phenomenal track record of corporate earnings compounding. And of course, the wealth creation which followed subsequently. I'm never tired of giving Titan as an example, but I'll just give you in 30 seconds. 10 years back, demonetization happened, right? The price of Titan was 340 or 350 rupees. It's a well-discovered stock. Covered by 40 analysts, very marquee shareholding pattern. It is not something which is not discovered. From there, it is up 12 times, which is a compounding of 30%. Yeah. 10 years have not crossed yet since demon. And corporate earnings, or rather the earnings for Titan have compounded at 25%. So you will find very such examples very, very rarely. Maybe 2 or 3 out of 200 companies that you possibly filter. And you will rarely find a company growing at this pace in a category where it enjoys dominant position, and more importantly, the category is also growing. A very rare and unique combination. And then, of course, there are intangibles like the management quality, the brand equity, the group, kind of, because it's a category which has a lot of trust-based issues. So having a brand like Tata obviously provides that additional premium on valuation, which you cannot capture in Excel sheet, obviously. So far, it has worked for us. We'll see whether it works in future or not. But as of now, we're very positive on jewelry category in India.
Titan, you've spoken about for years in all your interviews. Any other examples that come to mind?
I would think even something like Dixon that we have seen. 8 to 9 years back, the company IPO'd with a market cap of, I think, 2,000 crores. September 2017, if I'm not wrong. And the company was already doing well. And even at 2000 crore, the stock was not cheap. But then in the subsequent 8 years, obviously post COVID, they benefited with the PLI schemes and they expanded their the playfield. They became huge in mobile, and then they entered into so many other components. The earnings kept surprising.
Yeah.
You know, earnings kept compounding at 30-40%. I know the stock has come off recently in the correction from whatever 18,000 to 10-11,000. But look at the scale of wealth creation which has happened there. From a market cap of 2,000 crores, in less than 8 years, it hit a 1 lakh crore market cap. The only EMS company which has positive operating and free cash flow, a good ROE, and complemented with good growth. Right? So high P, but still generated massive return. Trend we just spoke about. In financials also there are examples. Bajaj Finance, you had Kotak Mahindra Bank also before the period of 2020 to 2025 when things have become far more flatlined there. But on high price to book, both HDFC Bank, Kotak Bank in that era from 2005 to 2020 compounded massively.
People are still talking about financials and PSU banks being the market leaders in this rally. What is your take on that?
So in India, you cannot have a bull market without financials contributing. Simple
Absolutely.
reason, 36% of the profits come from financials in Nifty. And they enjoy somewhere about 37-38% weight in the index. Now look at the scale up in financials profit pool. 2018, for the 70 financial companies that we track at Motilal Oswal, the total profit pool of this 70 companies was 49,000 crores. And that was a bottom year for financials profit cycle because asset quality pressures had peaked out that year. Some banks had reported loss. In fact, in my coverage that year, 6 PSU banks had reported a loss of 30,000 crores, 28,000 crores. Now, 2018 to 2025, Shrishti, the profits went from 49,000 crores to 5 lakh crores, 4,93,000 crores, almost a 10x jump, right? Because the gross NPS came down, asset quality has been great. There has been a lot of cleanup in the balance sheet. So while PPOP would have grown at 15-16%, the profits went up 10x in 7 years. A massive compounding of more than 30%, right? So financials in India will remain an evergreen sector in my view. Just that within financials today there are a lot of options. You know, gone are the days. 20 years back you had to choose only between a private and a PSU bank.
Yeah.
Then came NBFCs. There were massive, a lot of listings which happened in NBFC lending side. In 2017, you saw insurance companies getting listed in India. In 2018 onwards, AMC companies started listing. And then post 2020, you've seen a lot of capital market companies come to the market. You have brokers, exchanges, wealth managers, depositories, and several other intermediaries. So within financials, the option has exploded. And as we keep talking about the economy going from 4 to 8, 10 trillion at some point of time in the next 5 to 8 years, it cannot happen without financials contributing through credit growth, through financialization of savings, because India is indeed turning from a nation of savers to a nation of investors. So whole gamut of financials will come into play. Banking, NBFCs, capital marketplace, you have insurance. So you can create a nice basket. Some stable, large banks which are growing in 12-15%. You can add some of this capital marketplace which are growing at more than 20-25%. Of course, they will be far more volatile, they will be far more cyclical. But over a period of time, we believe that capital market theme in India is going to create massive wealth. One of the most favorite theme of ours since last 2-3 years. So financials will be the key driver of earnings and market cap creation. In fact, even in the short term, next year we are talking about 15% Nifty earnings growth. It predominantly rests on the shoulders of financials, because in financials we are projecting 17% earnings growth.
Right.
So if that doesn't happen, then the Nifty 15% earnings growth is also under risk.
And what would you say are red flags or like sectors to not be invested in today's time?
See,
You've said consumer staples.
no sector is ever a permanent red flag, and no sector is ever a permanent green flag, for want of a better word. I think today, the way we look at things, we are finding consumer staples slightly unattractive on the growth paradigm, and given the valuation that they're commanding still. So we don't like that right now. We are underweight commodities because we think commodity prices after a sharp upswing in the last 6-12 months, and we missed that. We've been underweight on metals. So
Yes, I
last
was
6 to
just
12
going to
months, we
ask
missed
you.
it. Yeah.
Yeah.
Now we don't want to chase it. Similarly, oil and gas, those are sectors we are underweight on. I would think even cement has done phenomenally well on earnings last year. And if you look at the pattern of cement profitability, every alternate year since FY22, 1 year is good, 1 year is bad on earnings. So FY22, 24, and 26 have been awesome on earnings. 21, 23, 25 have been terrible. So now we are hitting the next year after a very good year. It's possible that they can have 2 good years, but I'll remain, we are neutral out there. So, I mean, in some sectors like cyclicals and all, we keep changing our views basis the outlook that our analyst has on the near-term earnings growth, near-term demand drivers for the sector, right? So real estate, we've been very positive in 2022, 23, and even 24. 25 we made it underweight, and now we have zero allocation to real estate. So you have to put sectors in 2 buckets, structural and cyclical, and then accordingly take a call and build a portfolio around it. So, but let me clarify, there are no sectors which we permanently avoid, and there are no sectors where we are permanently overweight. We've been overweight on private banks for a large part of last 10 years, but now we are underweight for last 1.5 years. We've been overweight PSU bank in a massive way for last 3 years. But in the previous 7 years, we were underweight PSU banks. So it all is all a function of your outlook on earnings that time, valuations, what are the catalysts, and how do you see the whole ecosystem evolving for that sector.
You're so deeply entrenched in numbers, Gautam. It always stands out. But, from the fact, are there any sectors which have positively surprised you or positively disappointed or negatively disappointed you?
When?
Like in
From
the
a time?
recent past?
So auto has been a good positive surprise, and we were lucky. We upgraded the sector in July. We upgraded thinking the sectors underperformed a lot. We were underweight. Valuations are okay. Expectations are very modest. So we went overweight on auto. And then after a month and a half, this GST announcement came. And then auto became the second or third best performing sector on a calendar year basis. If you look at the returns of auto in the first 6-7 months in calendar 25, it was nowhere near the top.
Yeah.
And then, if you look at it on a 12-month basis, it's done really well. We like the sector. Earnings have been phenomenal. In fact, in my total profit pool this year, auto will cross 1 lakh crore of profit. It's a big number.
Yeah.
Out of 14.6 lakh crore that I mentioned, 1 lakh crore will now come from auto.
And two-wheeler versus four-wheeler?
We like both. So we've been also another stock I forgot mentioning about when we were discussing growth and high quality companies, TVS Motors, one of our other favorite names.
They've captured the whole EV market.
Within my coverage universe of 355 companies, this is the only company which for a 15 or 20 consecutive quarters have grown EBITDA and profit upwards of 15%. Maybe there was one quarter of some exception because of some other income or something. Profits went from 600 crores 5 years back to 3,600 crores in FY26. Next 2 years, we're expecting a profit of 5,800 crores. Margins went from 8 to 12.5. We're expecting 13.8 in next 2 years. Stock has been expensive, but high ROE, high growth company, gained market share in the last 5-10 years in virtually every segment they are present in. Four-wheeler, we like Mahindra & Mahindra. Phenomenal wealth creator for us. We took a call of adding Mahindra & Mahindra at a price of 900 rupees. We removed Maruti at that time. Since then, we've not added Maruti back yet in our model portfolio. We still have Mahindra & Mahindra. Again, good company, consistent ROE, delivery under Nanisha, 20% odd earnings growth, gained market share in both the segments. Tractors and both SUVs are doing really well. And more importantly, their subsidiaries also become value accretive now. Plus the kind of plans they have for the unlisted subsidiaries, I think it can end up surprising even from here on a next 3 to 5 year basis. So auto has been something which we flipped our call in July 2025, and we are still overweight there.
Yeah, I think it's one of my sectors that I'm personally looking at as well. Thank you so much, Gautam, for taking out the time. I know we had limited time today, but this was fantastic. I think you've shared some fantastic ideas with the audience. And next time, maybe we'll do a longer session.
Thank you.
Thank you very much. Thank you for watching today's video. If you enjoyed the video, please remember to subscribe to our channel. It really helps us in bringing you better and better content each time. In today's episode, we covered so many sectors and companies that Gautam is personally excited by. If it gave you interesting ideas, do let us know in the comments section. Thank you for watching.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.